All right. So, hello everyone. This is Coach Joshua Amoshuka, and the purpose of this evening's conversation is to talk about risk management when where it comes to trading in the financial markets. Um, I was on the phone with someone a few hours ago, and he told me that he had lost $5,000 in a single trade. You know, um, and that just got me upset. Okay, and You know, uh, you see, John Leal. So there's something I got to learn from John Leal and a couple of other traders. When you listen to a lot of people who have spent time in this market, when you listen to people who have been doing this for 5 years, 10 years, they say the fastest way to get somewhere is to ask a person that has been there before. It was Isaac Newton who said, "If I have seen further than others, it's because I stood on the shoulders of giants." And so we don't have to learn from our experience. We don't have to learn from our experience. Please, I need you to say it to yourself. I don't have to lose money to learn. I don't have to lose money to learn how to manage money. Now, I shared my story with some of you on previous calls, and I told you people about how I lost huge amounts of money last year because of my just due to carelessness, bad risk management. And then the problem with bad risk management, and I was saying this morning to the guy that I was talking to, I said, look, sometimes you start in your trading journey, once you get into a place where you are hoping that the market reverses, that the market turns around. Once you start hoping, you are doing it wrong. You are going to have to tame yourself as you would a dog. As I was speaking to him, and look, just forgive me if I'm sounding very strong and authoritative and didactic, and I'm not talking down at you. I don't want you to lose money. I nearly had a heart attack last year because I ended up $20,000 in debt because of my bad risk management. You see, I was using a robot at the time, and the robot had been consistent for 11 months. On average, it was doing 15% to 30% every month, a Forex robot. And so because of that, I got careless. Okay, I became an idiot and I started taking stupid risks, saying, hey, instead of making this small money, instead of making this small 15%, right? Because I started with $1,000. And then before you knew it, I increased my capital. I added $4,000. And then before you knew it, I now, as the robot was trading, I started copying the robot. And look, I got to learn the hard way. I don't want you to learn the hard way. So I'm speaking with this amount of energy and power because I love you and I don't want you to learn the hard way. I've come to realize, I've come to learn something. And this thing is consistent with so many traders. Forex trading, Forex trading is 80%. Well, so maybe I shouldn't allocate a percentage, but it is majorly money management. Money management to a degree, and in this case, because we're depending on educators here, money management is almost more important than your skill level, than your win rate. And John Leal demonstrated this thing so beautifully for us some weeks ago, where you could see that John Leal could actually lose more than 50% of his trades and yet still be in profit. How can you have a 40% win rate and yet you are still in profit? It's because of money management. So I want you to say it to yourself, I am an excellent money manager. I
I'm an
am an
excellent money manager.
I am an excellent risk manager.
I'm an excellent risk manager.
Once you understand this thing, guys, one, a lot of the anxiety and pressure that comes with Forex trading, you won't have it. There's some of you who because I've been there before. You are in a trade and you are checking 1 million times. You are checking 1 million times. You are checking the trade 1 million times. The reason you are checking 1 million times because you are hoping, I hope this trade goes to profit. I hope this trade goes to profit. So there's an anxiety that comes with trading. The moment you are feeling anxious, the moment there's anxiety, you are already doing it wrong. You see, there's something that they say. They say, before you take any trade, determine first how much am I willing to risk on this trade. And so that's what I hope that the practicality of being able to calculate what to risk is what I'm hoping to eventually get to on this call. But before you take a trade, the first thing you have made peace with is that this is how much I'm willing to risk, and meaning this is how much I'm willing to lose. So if I lose this amount, no problem. No problem. So a tap to trade comes in. You have decided this is, and how do you decide how much you want to lose? The way I do it and the way I recommend that you do it. If you have a $50,000 account, for example, we've been made to understand that you have a daily drawdown limit of 5%. 5% is $2,500, meaning in one day, your capital should not drop by more than 5%. And then the second rule is overall, your balance must not exceed a drawdown of 10%. So in other words, you must not lose more than 5K. And in a day, you must not lose more than 5%. Now, I need to quickly say this because somebody lost her account and it was so painful. She didn't know this. The 5% is calculated on a daily basis. That's why we said the first thing you should do every day before you start taking trades is number one, check Forex Factory. What are the news events today? You guys saw some very violent swings on the market a few hours ago. It was because of news. So whenever there's news in the US, it affects XA gold, XAU USD will affect Bitcoin. Anything that's traded against gold will affect it. So the first thing you do every day is you go to forexfactory.com, check the news. What time is there news today? So you can try to avoid, if you can, avoid trading during the news. The second thing is you want to check your daily drawdown limit. Now, this person on her 50K account, she had made over $3,000 profit. And so she assumed that since she had $3,000 extra, that means first of all she could lose her 3,000, and then from her 50,000, that's when it will start counting the drawdown. No, your 5% is on your starting balance for the day. So it's not as if that 3,000 has given you additional 3,000 buffer. So like let's say you started with a 50K account and 5% is 2,005. And then since you've made 3,000 profit, you now think that, I think she had made like 4,000. She had made like 4,000. So you now think, okay, my daily drawdown of 2,500 on my 50K and then 4,000. So that means I can afford to lose 6,005. That's not the way it works. They are not adding the 4,000 as an additional buffer. Your initial capital, if you're starting with 54,000, your daily drawdown limit will be 5% of 54,000. So just to eliminate any ambiguity or confusion, just every day, go and check. Go to Forex, to TradeX Mastery, check your daily drawdown limit for that day. Now, we want to now decide, and this is how I would recommend that you handle your account. Make allowance, give yourself 9 lives. What do I mean? If my daily drawdown for the day is 2,500, I will divide 2,500 by 10. Meaning on each trade, I'm not willing to risk more than $250. On each trade, $250. So I would need to lose 10 trades in a day for me to be disqualified from the challenge. So I'm saying give yourself 10 lives. If two of us, I don't know if you played video games when you were much younger, but the way you will play when you have 10 lives, Super Mario and all of these games, when you still have 10 lives, you can afford to, to fool around and to just, but once you have only 2 lives left or 3 lives left, now you have to be very extra careful. So if your daily drawdown for the day is 2,005, why should you allow yourself lose 1,000 in a trade? Why should you risk 1,000 in a single trade? That means you're basically giving yourself two lives. I don't know if I'm making sense. You are giving yourself two lives. That means 2005. So 1,250. So if I lose 1,250, I have one life left. I lose another 1,250. No, that doesn't make sense. That's bad money management. That's bad risk management. So my daily drawdown is 2.5. I will divide it by 10. And in each trade, I'm not risking more than $250. If you have a bigger account, if you're trading with a 100K account, then your daily drawdown limit of 5% would be 5,000. So I'll divide 5,000 by 10. So on each trade, I'm willing to risk $500. If you are risking smaller, well, I don't really know if you it will take you a longer time. If you have a 1 year subscription, no problem. You can decide to risk a lot smaller. But in terms of percentages, if you have $100,000 account, right, your daily drawdown is 10% overall. That's 10,000. Your daily drawdown is 5,000. And I'm saying divide that into 10 and risk 500. What percentage of 100,000 is 500? That's 0.5%. So in essence, I'm saying risk 0.5% per trade. That's still okay if you're risking 0.5% per trade. Now, probably with the exception of Jewelerias, probably, because he uses a big stop loss on his trades. So I want us to now do some calculations to see how you can arrive at these numbers. But I'm saying actually, you can actually risk 0.5%. Jewelerias, well, there have been very few occasions where he lost. I mean, there were some days that were pretty bad where he was just dropping trade, back to back, but he rarely does that. It's happened only like twice, where like he went on a losing streak. We lose one trade, drop another one, drop another one, drop another one. Now he has his trading plans. He has his trainings, about trading plan, and we all need to have. So this discussion basically is really about trading plan. So you also need to decide at what point do I stop trading for the day? Okay. So yes, I've given myself the allowance of 10 lives, but do I want to exhaust it in a day? I don't. So if I lose 3 trades, I'm done. At the most 4, I'm done. In a day, at the most, I'm done. So I now want us to do some calculation. And if you have questions, you can either raise your hand or you can yeah, so just raise a hand. So I'm going to share my screen and I'm going to try and do some calculation, and I want us to try and follow along. Okay. I went over this in the other training on NAS. This is an emergency thing because I saw that I shared the Liberty strategy and some people have started taking it, but they don't know how to apportion their risk. And so they are, as a result, losing too much. The idea behind the Liberty strategy, okay, and why I recommended it so confidently is because of the risk to reward. Please let me know if you can see my screen. Let me know if you can see my screen. It's because of the risk to reward. Can you see my screen? Can you see my Word? So I'm in Microsoft Word currently. You can just type it in the chat if you can see my screen. Can you see my screen? Can someone just type just type 111 in the chat if you can see my screen? Okay, yes. All right, good. Now, so the risk to reward, the reason I recommended that Liberty strategy is because of the risk to reward. With the Liberty strategy, if you are risking $1, it's because you are hoping to make $4. So that's a risk to reward of 1 to 4. And that's when you listen to professionals, right? And I've taken time, I've listened to so many. Some of them within a cash expert, some outside, podcasts, trading podcasts. And they talk about this thing about risk to reward and money management. Now, that's really the essence of trading. You don't have to be so skilled. You don't have to be so skilled that, oh, every time you're winning, it's just money management. So let's look at this together. Okay. If whenever you risk $1, you make $4, what that means is, let's assume that you took one trade and the trade hit stop loss. You took another trade, it hit stop loss. You took another trade, third trade, it hit stop loss. You've lost 3 trades. And then you took a fourth trade and that one hit your TP. If you're losing 3 out of 4, that means your losing rate is 75% and your winning rate is 25%, right? But your risk to reward will determine if you'll be profitable or not. Now, with a 1 to 4 risk to reward, when you risk $1, you are hoping to make $4. So you are waiting for opportunities that present in the market where anytime you risk 1 is to make 4. In this example, you've lost the first trade, second trade, third trade. You've lost $3. But on your fourth trade, you've made $4. You are in profit of $1. Are we seeing this? You've lost 3 trades out of 4, but yet you are in profit. You're in profit. You are 25% up. So that's the importance of risk to reward. And that's why I shared with you guys the Liberty strategy, because it has a high risk to reward. Okay, so now let's quickly look at how to calculate, the risk and the lot sizes. So we already established something. If your account is a $50,000 account, we've been allowed 10% overall drawdown and 5% daily. Okay, so on a 50K account, increase. So what this means is, on a 50K account, 5% daily is 2,500, and overall is 5,000. I said divide daily limit by 10. This is my own recommendation. Okay, divide daily limit by 10. So in this example, if you have a 50K account, you are dividing your 2005 by 10. What that means is, per trade, you are going to be risking $250. So if I was to take a NAS 100 trade, how would I go about this on my 50K account? How would I go about this? I don't want to risk more than $250. But keep in mind, because of ratio 1 to 4, we said the risk to reward, trading the Liberty strategy, the risk to reward is 1:4. Meaning that whenever I risk $250, is because I hope to make $1,000. I hope it's making sense. I'm risking $250 to make 1,000. So I've already controlled my risk before I take a trade. It's not that you enter the trade and then it's going against you, and then you're now hoping that this thing turns. Then you watch it go from 100 to 150 to 200 to 300, 400. No, you've already started going against your rules. Stick with your rules. Stick with your rules. So I want to risk $250. I have a 50K account. How do I do this? How do I calculate this? So first of all, we need to understand that with NAS, or maybe we should start with gold. Let's start with NAS since, I'm focusing on the Liberty strategy. I'll also still come into gold. With NAS 100, $1, $1 movement. Okay, so let's say current price is 21,000, or should we call this entry price? Is 21,000. If price goes from 21,000 to 21,050, this is a $50 move, right? It is a difference of $50. But in terms of pips, it's a difference of $50. But each for NAS, each dollar equals 10 pips. Each dollar, each dollar equals 10 pips for NAS. So in this case, in this example here, okay, let me move this up. What just happened? NAS, each dollar is 10 pips. So price moved from 21,000 to 21,050, which is 50 pips, $50. If each dollar is 10 pips, and this is a $50 move, how many pips has it moved? How many pips has it moved? If each dollar is 10 pips, if each dollar is 10 pips, and the price has moved by $50, how many pips is that? That would be 500. So a $50 move, whether up or down, a $50 move will be equal to 500 pips. Now, Rich Vendiga did a very good job of explaining this in the video he just uploaded for Liberty Strategy. But for some of us who may not have an active subscription, you'll benefit from this. Okay, so the rule for Liberty is whenever you are taking a trade, risk only 500 pips. Okay, so how do I know what lot size? How do I know what lot size that I'm going to use? How do I know what lot size I'm going to use? If I use a 0.01, 0.01, multiplied by the pips. So, okay, it's telling me my meeting will end in 10 minutes. A 0.01 lot size is equivalent of 10 cents. A 0.01 lot size, I hope this is not going to confuse anybody. A 0.01 lot size is equivalent of 10 cents. A 0.1 lot size is equivalent of $1. So to know your profit or loss, how much am I going to win? How much am I going to gain? To calculate profit or loss, multiply the lot size dollar value, dollar equivalent. Lot size multiply the lot size dollar value times the number of pips to calculate the profit and loss. Calculate your lot size dollar value times the number of pips. Okay, somebody sent me a message. Would it be okay to use my drawdown as a case study? I'm at 45,174. Okay, I understand I would have to stake much lower lot size and take fewer trades per day and build up gradually. Okay, I will come to this example, but so I probably have like 7 minutes and this will disconnect. Once it disconnects, you just click on the link and it will bring you back in. Okay. So I'll come to that example and use that as a case study. So sorry about that. Um, okay. So to calculate your profit and loss, what you would make or what you would lose, you need to multiply your lot size, the lot size dollar value times the number of pips. So in this example, so remember what we said. So first of all, if I'm going into a trade, I need to decide upfront how much I'm willing to risk. And we've said in this example of a 50K account, divide your daily limit by 10. So I want to risk $250. I want to risk $250. So what's his name? He sends a trade and he puts the entry price as 21,000. As 21,000. And he always uses a 500 pip stop loss. Always uses a 500 pip stop loss. So that means his stop loss will be 29,950. This is for the Liberty strategy. So in trading, your first business is preservation of capital before profit. Capital preservation before profit. So the first thing is my stop loss. Okay, the stop loss is 500 pips. How do I arrive at this to know how much I want to risk? Trade Locker actually makes it quite simple. Trade Locker actually, it makes it quite simple because with Trade Locker, okay, let me open my Trade Locker. Can you guys see my screen? Is my screen showing? I'm in a trade. I didn't even know I was in a trade. See me, oh. So this is another thing. If you set pending orders, it's dangerous to set pending orders and and go out, like go to pick your kids or go and do whatever. If you set pending orders, they can trigger and you don't even know. You would have forgotten that you were in a trade. Just like I have here now. Let me just close this. You would forget that you were in a trade and you know that's how people can. I mean, I usually always put a stop loss whenever I'm setting a pending order, but so I want to demonstrate the example here. Can you see my screen? I've opened Trade Locker. Can you guys see my screen? If you just type in the chat, let me know if you can see my screen. Um, where is chat? Can you see my Trade Locker app? Can you just type a one in the chat if you can see my Trade Locker app? I just opened my Trade Locker. Can you guys see it? Can I get some feedback? Can you type it in the chat if you can see my Trade Locker? Okay, you can see it. Okay, awesome. All right. So we want to take a trade on NAS. So a trade alert comes in. Okay. It's taking time to load. It hasn't changed. I've clicked on NAS, but it hasn't changed on the on the screen. You know, Trade Locker makes it quite simple. Trade Locker makes it quite simple. Come on. I need to launch the app again. You know, the mistake we initially made, and I also made this mistake too, was thinking, oh, NAS is too volatile, NAS is too dangerous, don't trade it at all. No, that's not exactly true. If you are risking the right numbers and your risk to reward is okay, as long as you know how to control the risk, as long as you know how to control the risk, then there's no issue. As long as you know how to control the risk. So NAS 100, okay, good. So NAS 100 has loaded here now, okay? So let's say he sends in a trade alert, okay? And then I come and I enter the trade. I'm just using a hypothetical figure. This is, this is not true. 21,000. That's the entry price. Remember, the stop loss is always 500 pips. 500 pips. So 500 pips. Okay, so also keep this in mind. What we have here is ticks on Trade Locker. 500 pips is the same as 5,000 ticks. 5,000 ticks. So can you see it has even put the price for me? 29.50. 29.50. But that's the stop loss that he sent, because Rich Vendiger always uses a 500 pip stop loss. But let's say you are using the Liberty strategy by yourself and you're not even waiting for him to send the alert. So the entry price that you're seeing is 21,000. You just calculate $50 below the price at which you are entering the market. $50 below your entry price is going to be your stop loss. He suggests 500 pips because based on what he has backtested, that will keep you in the game. So can you see here that it's $250? So look at the lot size. The lot size is 0.05. So with a 0.05 lot size, it will keep my risk at $250. But what happens if I change this lot size to 0.1? Look at what will happen. If I change it to 0.1, watch what will happen to the numbers here. It means I'm going to be risking $500. 21,950. What's going on? 5,000 ticks. I don't know what's happening to trade.